Let's get in Pankaj Murarka, CEO and Chief Investment Officer at Renaissance Investment Managers on the show now. Pankaj, thank you very much for joining in and good morning. Now, the question is, we've seen early green shoots of a recovery last week. Does it extend and what will be the nature of the recovery? We've had a slide over the last 5 to 6 months. Is it going to be a very gradual recovery? Is the bottom in place? Or is there a risk of a W-shaped recovery, which means we recover, but again, renewed selling pressure comes in at higher levels and markets trend down? How do you expect the next few months to pan out?
Hi, Reema. Morning. I wish I had an answer to all of this. Market behavior always, is an enigma. All I know is, or the assumption that we're going with is we still believe that the broader bull market is still intact. Having said that, it's a very matured bull market because this March we finished 5 years, the bull market started and onslaught of COVID. So it's a very matured bull market, but we still firmly believe that we are very much in a bull market. The correction that we've seen over the last 5 months is more a correction in a bull market. And from a market direction perspective, our broader sense is that somewhere we are closer to a trough in terms of aggregate as far as the large cap indices or Nifty index is concerned. Probably markets will consolidate at these levels for the next few months before we make the next move up. Having said that, I still believe that if you look at last year, CY24, the Nifty index did about 9% return on a full year calendar year basis. And we still think that given that we are in the midst of a cyclical slowdown, the economy and earnings slowdown, this year Nifty 50 earnings growth is just about under 5%, probably the weakest earnings growth that we've seen in the last 5 years. I think the returns this year could be as well into single digit at the Nifty 50 index level. But I think more importantly, what we had seen was a fair degree of fear in market over the last 8 weeks and a significant unwinding across the market. The breadth of the market was very bad. I think that one-way selling across the market probably will take a pause, and from here on it will be more fundamental driven and stock specific. So there'll be a wider dispersion in the behavior and performance of stocks, I think. But I think the broad-based sell-off is done, and probably my assessment is that probably as far as the Nifty index is concerned, we have made a trough because now valuations are at about 10% discount to the last 15 years averages, which is very comforting. And more importantly, we see growth picking up in the second half of this year. So probably growth in the second half of this year will be much better than what we've seen in the last 15 months.
Okay. Hi, Pankaj. Good morning and good to see you. When there's been this debate whether or not we're going to get into a sticky territory, and some people are also calling for a bear market. Clearly, going by what you're saying, you're not in that camp. You believe at least the headline index, well, we seem to be making a bit of a bottom in place. Is that correct, right?
Absolutely, Nigel. I'm not in the bear market camp. I think we are very much in a bull market. The only caveat is it's a very matured bull market. At a point in last year, September, at index at 26,000, valuations were rich. We have been over the last 15 years the most expensive equity market in the world. In the most expensive equity market in the world, where valuations are rich, and when you get an economic cyclical slowdown in the economy and earnings slowdown, markets will correct. And which is what exactly we've seen in the last 5 months. Having said that, I still believe that the broader bull market very much remains in place.
Okay, let's talk about a couple of sectors then. I think you like the discretionary spends, right? And I think you were talking about last time around, we're talking about happier things. Pizza, whiskey, Jubilant Foodworks, United Spirits. Now, the hope is that rural economy comes back because of, what's happened in the budget. And because that's seen a fair bit of pain as well. How are you positioned now on the consumption theme?
So, absolutely, Nigel. With a gap of almost 4 years now, I was starting consumer as a sector. We've been underweight consumer as a sector for almost 4 years post-COVID. But we think we've reached a point. If you see the last 2 years, the PFC, the private consumption, has been growing at about 6%, which is half of the last 10 years average. The last 10 years, PFC growth has been about 11-12% and has been ahead of nominal GDP growth. The rural consumption slowdown in India started, we're already 2 years into a rural slowdown because the rural consumption started slowing down in June 23. But I think we've reached a stage where we are at a very low point of consumption. Most of the headwinds are behind us. And more importantly, we see some green shoots, I would say, of revival in consumption. They're still early days. But I think we are seeing those in terms of early revival in some segments or pockets of rural consumption. And more importantly, the government itself has made a pivot this year. We've seen in this budget, the last 4 years, significant part of government resources were allocated towards driving central government investments. And this time, the budget has been a more balanced budget across investments and consumption and started with a tax break. Over the weekend, the finance minister is talking about GST rate cuts, I think, which is very important because high inflation has had a really impacted consumption in the last 2 or 3 years. So probably that will be very helpful. So I think we are in an early stage of a consumer recovery. I think the recovery will gather momentum going into the second half of this year. So if on an aggregate, meaning when I look at the market, probably consumer as a sector looks probably the most promising to me across sectors within the markets. And within that, our bets are placed across both staples and discretionary. So while on discretionary, we like some of those stocks, including Jubilant Foods and United Spirits, we like staples as well because we think that staples will see recovery as well as rural consumption improves.
What are the other big portfolio calls you all are making?
So, Reema, at this point of time, the approach is slightly, meaning while that's not an approach, but the way it comes up as investors, we are bottom-up stock pickers. So, what it comes across is our portfolio is looking more contrarian. We like financials, and within that, private sector financials, again, a sector which has not done well for the last 2.5 years. And some of those boring names like HDFC Bank and Kotak banks are really now our favorite ones because we think the headwinds that these companies had over the last 2 or 3 years are behind them, and probably they will lead growth recovery going into the next 3 years. Valuations, the stocks having remained flat almost for 3 years or 4 years, valuations are far more compelling and are significantly below where these stocks have traded over the last 10 or 15 years. And so we like private sector financials along with consumption. And we continue to remain positive on IT as a sector because we still think that despite a tail risk of recession in US, discretionary spends in US towards IT will keep increasing through the course of the year.
Any thoughts on Innocent Bank and the news flow? Because you'll analyze private sector financials across. While it's not your favorite or preferred pick, it's HDFC Bank and Kotak Mahindra Bank. But your thoughts on the developments?
Well, so we think probably HDFC Bank is in the last leg of dealing with the challenges of absorbing HDFC as a conglomerate because it's been now 8 quarters into it. It was one of the biggest M&A that we have seen in the financial sector, even from a global standards, at $90 billion. And when you do such a large M&A, it does take time to digest, absorb, and integrate. HDFC Bank, to my view, has gone from being the fastest growing private sector bank of India for 20 years to being the slowest growing private sector bank of India in the last 3 years. I reckon, or we believe that probably in 3 years' time from now, it can go back to being the fastest growing private sector bank in India. And if that be the case, then apart from strong earnings growth, I think HDFC Bank's valuation, which have got derated over the last 3 years, will again will get re-rated. They might not go back to where they were because historical growth rates will moderate going forward, but still we see significant valuation uptick in HDFC Bank from here on.
I was actually asking on Innocent Bank.
Oh,
any thoughts?
Not really, meaning we do have thoughts, but it's not one of our preferred bets, Reema, in that sense. We don't own that. As investors, we are moderate risk investors or low risk investors, and we usually don't like banks which have significant exposure to microfinance as a space because our experience over the years has been that every 5 years you get some very significant credit costs coming into that business. So we've stayed away from banks which have significant exposure to microfinance.
Pankaj, hi, morning, Surabhi here. So I guess the big issue with the street is buying large caps is fine. Most people are saying that it's relatively safer to buy large caps, right? The issue is that should you venture into mid caps at all? And if yes, which are the pockets that are looking, well, relatively safe, where there's some growth, where valuations have cooled off as well? I mean, what's your thought? The whole large cap versus SMID debate. And what would you buy in SMIDs after this correction?
So I think one should definitely invest into mid and small cap, but I think at the index level, I still think that this year the large cap, unlike the last 2 years, 2023 and 24, the mid and small cap index outperformed the large cap index. Probably this year could be a year where the large cap indices outperform the mid and small cap index. Having said that, it's not that mid caps or small caps will not make money. The only point I'm trying to make is that unlike last 2 years where every stock in mid and small cap made money, from here on it will get more stock specific. So the dispersion within the index or within the group of mid and small cap will increase very significantly. So one will have to be very careful in terms of picking the right stocks. And when it comes to mid and small caps, because these are companies which are mid-size or small size, those sector approach doesn't work as much because you have to get the business model and the management right. So bottom-up stocking plays a more important role. Having said that, we still like, meaning some of the companies I mentioned, like Jubilant, we are betting on revival and discretionary consumption. So Jubilant Foods is a classical mid-cap and a caveat. We own that in our portfolio, so we like that. Likewise, we like some of the other names on the discretionary consumption side because I still believe that we'll see a recovery in discretionary consumption over the rest of the year as well. The CRAM story looks still pretty promising. Most of the CRAM companies in India in the healthcare space are still mid caps. We don't have a large. I think probably in 10 years' time we'll have a company from the space which will be large cap. DVs is there, but I think there'll be more companies which will emerge because the opportunity size out there is very significant. So some of these mid cap CRAMS companies look very promising.
Okay, fair enough. Yeah, I mean, intrinsically, I'm sure big opportunities over there. It's just that it's a very, very complex and confusing landscape with so much of tariff talk. But take your point. Thank you, Pankaj, very much for joining in and giving us some perspective on the market.